South African consumers lost nearly R500 billion of wealth in 2018. That's according to the Momentum and Unisa South African Household Index released today. Last year saw 6% of households' net wealth shrinking by nearly 450 billion rand. The increase in the level of indebtedness and a reduction in the value of retirement savings have contributed to this. The decline in household wealth contributes to slower economic growth and job creation and could lead to the low and middle income groups not having enough money to retire comfortably and cope with emergencies. For more on the story, I'm joined by Johann van Tonder, who's a researcher and economist at Momentum. So what does this actually mean when you break it down?
Well, in one word, people are getting poorer. But let's try and explain it. It's the value of their assets, and their assets comprise of their residential assets, in other words, your home, your belongings, and then all your savings, like in your pension fund and so on. So that's declined last year in real terms. So if you take that and subtract that, or subtract from that all your debts that you owe, you get to your wealth. Now, if your wealth declines, in other words, the value of your property as well as of all your savings go down in real terms, it means what you can buy one day with like your pension money and your income that you're going to earn when in retirement, you're not going to be able to live. You're going to have to basically sell your house and move into a smaller place, or sell your cars, or buy less food, or all those kind of things are going to happen. And currently what's going to happen is, because you feel poorer, you're going to spend less. And if you spend less, actually it's having a negative impact on the economy and economic growth and job creation, and even your savings for the future as well.
Okay, the study found that 6.3% of households' real net worth was wiped out over the course of the year. That, together with that 450 billion rand, is quite alarming. How does it compare to, say, the 2009 recession?
Well, in the 2009 recession, the amount lost was like 15%. So it's not as big as then, but it's the second biggest since the recession. So it's quite alarming. It's definitely something we need to worry about, because if we don't recover some of those wealth that we lose, a lot of people in different income groups will just suffer. There's no other word putting it.
Mm-hmm. So what domestic and international factors contributed to this loss and this drop in wealth?
Yeah, that's the sort of painful thing. A lot of it's got to do with what happened in the United States and China. So the trade war in China contributed to the value of share prices in a lot of emerging markets declining. And our pension funds are sort of invested in companies listed on a stock exchange. So that trade war caused a lot of uncertainty and caused a lot of share prices to go down. But it's not just that, it's also lower international economic growth coming through. And then other factors domestically was like load shedding. We had a recession last year, and in addition to that, we had lots of policy uncertainty, such as what's going to happen in terms of land expropriation without compensation, what's going to happen if the Reserve Bank's going to lose its independence. The markets reacted negatively to all of those things, which in turn affected the value of all our savings, household savings, on the stock exchange, etc.
So you've spoken about some of those ramifications like you've just mentioned now, but if I'm watching and I want to know on a day-to-day basis, both if I have those insurance and pensions, and if I don't have a pension and savings, how does it affect me?
If you don't have an insurance and savings, well, if you're going to retire, you're not going to have money. You're going to have to rely on other people to take care of you. But if the other people who need to take care of you, if they don't have money because of the drop in their wealth, they're going to struggle taking care of you as well. Mm-hmm. And in addition, what we've learned is, in volatile times like we have now, what we have is that if you're not protected against like all these problems and challenges, you're going to find it extremely hard to recover if something happens to you. So for the man in the street, I would say they need to go carry on right now, saving, carry on with their insurance where they can, because if you leave it now, what tends to happen is normally something bad will happen to you. So don't increase your risk, continue with what you do, because what we've seen is a mild recovery. That's a good news.
Thanks so much for your time on SABC News today. Johann van Tonder, researcher and economist at Momentum, joining us in studio there.